They say you can't time the market. It's time in the market, not timing the market, they say. Yeah, do you know why they say that? It's because they don't know how. You can absolutely time the market, and today I'm going to show you how. Now, it uses a set of 7 free indicators that, when combined, will empower you to know whether you should be in or out of the stock market. Now, as the time of this recording, it is the first week of October 2025. The stock market is sitting at new all-time highs, as you can see here in this chart of the SPY. Now, I'm going to show you each of these, both what they look like now when the market is healthy and what they will look like when it signals it is time to get out. And we're going to start with this, the net new highs and lows. Now, this indicator is free. To add it, at least using TradingView, simply click on Indicators. You're going to type in U.S. Markets Net New Highs/Lows. And there it is at the top. Again, it is a free indicator made by Matt Caruso, is a phenomenal trader. This is a free indicator he's put out there. There's others as well, but add that to your chart. The color is going to look a little bit different than mine. I've tweaked them, but that's up to you. And here's what this is. Just as the name implies, it looks at the net number of stocks that have made a new 52-week high on the day versus the number that have made a new 52-week low. And you can see in that white box over there in the left corner, if you look at yesterday's reading, 221 stocks made a new high for the year, 73 made a new low, and the net reading is positive 148. So it is a green bar above the zero line, and when you get 3 of those in a row, the background paints green and vice versa in red. Now, there's a few different settings in this indicator, and you can decide which stocks you want it to look at. I keep it pretty broad, which means the top 3 exchanges. That's Nasdaq, New York, and American exchanges. If you just wanted to look at, say, tech stocks, you could have it just focus on the Nasdaq and get different readings. But I want to see it broad-based. And the way you're going to use this is you just want it to be green, right? In a strong bull market, you want to see broad-based participation. This is the secret to everything, okay? You want to be sure the market is not going up just with a small handful of stocks. That's the condition we're looking out for, because that's what you see before the big market crashes, all right? And so if you are, in fact, seeing broad-based participation, if the market is rallying and the economy is strong, you should have more stocks making new highs for the year than lows. There may be the occasional day where that's not the case, like we saw over in here on August 1st. We had one of those days on September 25, but by and large, this thing is pretty darn green, right? And so as long as you are getting a pretty consistent stream of net new highs day to day, the market is still strong. To contrast that, this is what it looked like during the tariff situation back in February and March. We went into a quick bear market. It turned red, and pretty much every day, other than barely these 2, more stocks were making new lows than highs, and it quickly turned, printed green, and the market has ripped ever since. And if you go back and look at like a big bear market like we had in 2022, you can see here that for the majority of the year, this was very, very red. There's little corners, there's little pockets where it flipped green. But so basically, you want more days of net highs than new lows. You want to see this printing green, staying green, and unless you get to a situation where you see 3, 4, 5 net new low days in a row, the market is probably continuing higher, okay? Next thing we're looking at, the advanced decline line. Again, free indicator, I've just got a chart here of SPX, which is the S&P 500 index. I've gone into indicators and added this, the accumulation distribution line. The advanced decline line is very similar to the net new highs, only it just looks at whether the stocks went up or down. Don't need to make a new high. Whether it went up 1% or 100%, that's up. And each day it says, all right, how many stocks went up? How many stocks went down? If more went up than down, it's a positive number, and vice versa, and it adds that number to the previous day. And here's how you want to use this. What you are looking for is divergences in the advanced decline line. This is a great example here when the market pulled back during the tariff war earlier this year. So we had up here at the top, you can see starting in February, the market came down. It fell, right about 20% there. Advanced decline line came down as well. But look what happened here by the end of April. okay? The advanced decline line was already up here making new highs. Meanwhile, the stock market was not even close. It was only about halfway back up. So that is showing you that beneath the surface, the market is very, very strong. Advanced decline line climbing faster than the index. That's a sign of tremendous strength beneath the surface. And of course, we have had this record-setting rally off those lows as the S&P is up 35% over just the last 6 months. Now, to contrast that, this is what it looks like when it's a warning to get out. So this was 2021. Again, the S&P 500 stock index is on top. The advanced decline line is on the bottom. And look what we saw. From June to December, the index was steadily rising higher, up over 10%. Meanwhile, the advanced decline line was showing you weakness. It was just straight sideways. It was not rising in tandem with the market. That is your warning sign that beneath the surface, we are not getting that broad-based participation. Stocks are just kind of 50-50 up and down over this period. And what's driving the market higher is a small handful of stocks. The indexes are market cap weighted, which means your Apples and Nvidias and Teslas and Microsofts carry much more weight. And so if those 10, 15, 20 stocks are rising, even though the other 480 are going down, the index goes up. However, the market was weakening, and that, of course, signaled what was to come, which was this 2022 bear market. Okay, so that's the advanced decline line. Next thing we're going to look at is the percentage of stocks above the 200-day moving average. Now, the 200-day moving average is this white line you see on the chart here. And for all intents and purposes, this is the line in the sand, so to speak, the separator telling you whether a stock is in a long-term up or down trend. And any stock in an uptrend, this is the index, of course. Here's the COVID sell-off. It got above, stayed in a long-term uptrend for 2020, 2021, into 2022, broke down beneath it. You're in a bear market. Gets back above the 200-day, rises all the way up into early 2025 when the tariff situation happened. Went into a bear market, came back and rose up. So it's just a very easy line. Institutions use this. Systematic traders use this to determine whether a stock is in a long-term uptrend or downtrend. So it stands to reason, again, it's all about breadth. It's all about market participation. It stands to reason that if we are in a strong bull market, we're going to have more stocks above this line than below it. So on top is the U.S. Composite Index. You can use SPY, you can use QQQ, doesn't matter, it's the market index. And on the bottom is the percentage of Nasdaq stocks above the 200-day moving average. Now what I've done is set up a dual chart. You can see here, the ticker for the bottom is NCTH, Nancy Charles Thomas Hulu. That's going to give you the percentage. And again, I've just drawn a red horizontal line there at 50. Now, as we stand today, this number is holding up here near its highs at about 65%. It rose strong off the bottoms. We'd like to see everything looks safe. It's why I continue to be bullish on the market. But again, I want to show you what to look at as a warning. Now, I'm going back to 2021 and 2022 again because that was really the last steady bear market. We had the 2-month sell-off in March and April from the tariff situation, but that was more of a black swan event driven by one particular thing, not market-based, and so those are much harder to predict. But notice here, with the percentage of stocks above the 200, we saw the same thing that we got from the advanced decline line. Here in 2021, the stock market is rising higher, while at the same time, the percentage of stocks in long-term uptrends fell from 90% to 40%. And if you've gone from almost every stock in an uptrend to less than half, you have to understand that is no bueno. That is not a good sign. It is impossible that the market is healthy when half of the stocks in the Nasdaq index have now gone bear. So if nothing else, you should say, I need to pull back. I am not confident in this market, but of course that did lead to the 2022 bear market. This number fell all the way down to 20. And then really, once it got above 50, And that was right over in here in January 2023. That's when you wanted to be back into stocks. And there was some wiggle in there, a little bit of chop. We get into a little bit of a pullback here in late 23 where the markets got ugly. But for the most part, when you look at the strong periods where stocks are rising, the percentage of stocks above the 200 is going to stay above that 50 line. When that changes, like happened here in February, it is usually time to get out. You will sidestep a lot of these bear markets. But the big picture, you just want to see this either rising or holding as it is now in this kind of 50, 60, 70% range, okay? So that's NCTTH, the percentage of stocks above the 200-day moving average, and hopefully it is more common sense. Now, one other indicator, and I've done an entire video on this that most people are not familiar with, is something known as the NFCI. The NFCI is Chicago Federal National Conditions Index. We don't need to get into all the details, but essentially this is a number put out once a week by the Chicago Fed that gives you an idea of the liquidity of the market. So it takes into account leverage, risk, a couple other things. It's like 120 or 200 different economic indicators, everything from LIBOR spreads to commercial loan officers' surveys to interest rates. And the idea being, and by the way, the NFCI is on top in blue, and the Nasdaq index is on bottom in white. The idea being, when this number is rising, it means that financial conditions are tightening. It is harder to borrow, there is less credit, it is harder to stay on margin, and when conditions tighten, there is less dollars flowing into the market, and therefore stocks typically come down. And if we look back, comparing the NFCI on top to the Nasdaq on bottom, there is almost a perfect one-to-one ratio. When the NFCI is rising, like it was here, stocks are going down. When it begins to fall, the conditions are loosening, meaning more money is going into the market, more leverage, stocks rise. It ticks up and stocks go down. It stays sideways or pulls down and stocks go up. And this inverse correlation has held for years, especially in these big trends here. So you look at the top here in 24, steadily drove down for 6 months as the market rose. Here, when the tariff situation came out, conditions tightened once again, stocks fell, and vice versa. So this looks like the absolute cheat code of cheat codes, right? There is one caveat to this, and that's that the Fed tends to come back and revise this number over the last 2 or 3 weeks and say, oh, we're actually off a little bit, let's correct it. So it's not going to tell you like to the day as it looks on the chart, but just in general, you want to see this falling. You want a trend of loosening financial conditions. You want the NFCI going lower, and under that environment, stocks tend to rise. If, on the other hand, you start to see it 1, 2, 3 weeks in a row, it is ticking upward. That is your sign. Conditions are tightening, and you need to be out of stocks. Now, one other thing I like to look at is interest rates, and not the way everybody else looks at interest rates. Everyone's like the 1 year, the 5 year, the 10-year yield. There's a big problem with looking at interest rates, and that is that there is no risk component to it. If you buy a government bond, you lend money to Uncle Sam, you are going to get paid back. They will tax the American people. They will print it if they have to. There is no risk. That's why it's known as the risk-free rate. But there are other interest rates. So I've got the Nasdaq composite on top. That's not really relevant here. The federal funds rate in yellow, again, not super relevant. This is the 10-year bond yield that is going down. But what we're going to focus on is down here at the bottom, which is the high yield index. This is the interest rate made to private businesses. And this has to reflect risk. So if you are a bank lending $100,000, $1 million, $20 million to some business, well, there's going to be different rates depending on how risky it is. If you were lending this to a 100-year-old company with a steady cash flow, you may accept 4 or 5%. However, if you were lending this to Jim Bob's Bait and Tackle, 6 months in business, their numbers are all over the place, you're going to demand a higher interest rate to compensate you for the higher risk. Well, this is that on a much larger scale. This is the high yield effective index. And so when this is rising, and we saw this happen in March and April, it went from 6.8% to 8.5% in short order. Why? Well, the economy was riskier. suddenly there's these massive tariffs being placed on other countries, and businesses that rely on raw goods from other countries, that sell their products to other countries or buy from them, suddenly the prices they pay for that are going to go way up. The environment just got riskier, and as a result, the rate banks charge to lend money soared up. Now, during that time, look at the yellow. The federal funds rate didn't change. The 10-year bond yield stayed in this kind of 4.2 to 4.3 range. But the high yield rate, what actually has a risk component to it, soared from 6.9 to 8.5. On the other hand, when conditions are viewed as less risky, when economic growth is strong, when there's not these big economic risks, banks will loosen the purse strings. This rate will come down. And just like all other interest rates, as they come down, stock prices tend to go up. As there is less competition from fixed income, as investors are getting less yield on the bonds they buy over there, they're more prone to buy stocks. Valuations rise since it is a less competitive environment, and it just fuels the fire. So between these 5 things, if you have a declining high yield index, and by the way, here's the ticker symbol for that if you want to screenshot this, BAML H0A0HYM2EY. I didn't make it, don't blame me. If that is going down, if the NFCI, the ticker is just NFCI, is trending lower, if the percentage of stocks above the 200-day, ticker NCTTH, is either riding or holding at highs, if the advanced decline line, if this indicator is steadily marching higher, showing broad breadth, and if the number of stocks making net new highs continues to rise, 98% chance you want to be owning stocks. You're in a strong market with broad-based participation that is rising. You want to be invested. So in that situation, there are also 2 things you can look at to buy the dip. Everybody loves a good dip. They're scared to buy it when it happens. Here's 2 ways to do it. Number 1 is the percentage of stocks above the 5-day moving average. Now, this is very, very short term. The 5-day moving average is going to be all over the place. But in the market conditions we're in now, where you have strong participation, when the percentage of stocks above the 5-day falls down here below 20%, that is usually FOMO selling. It is some kind of fear, some little short-term event has happened. The president said something, the Federal Reserve chief said something, who knows? But if you look at these, and again, we're kind of Monday morning quarterbacking because it's been in a strong market, but when these conditions are met, these were all really good buy points. And if you look back in here, not all of them are right on dips, but some of them were perfectly on dips like we saw here on August 1st. So if you're looking to add in and you don't want to just chase highs, add this. The ticker symbol is NCFD, Nancy Charles Frederick David. Just make a double chart, put it on the bottom, draw your horizontal line at 80, one at 20, and the one at 20 is the dip buying. The other thing you can do, and I've talked about this for years, is look at the put-call ratio. Once again, I've just got a dual chart made. On top is the SPY or the SP 500. On bottom is the put-call ratio, and it's the ticker symbol, in TradingView at least, is just PC. Now, here's what the put-call ratio is. It says how many people are buying puts and how many are buying calls. If you're buying put options, you're betting on stocks to go lower. If you're buying call options, you're betting on stocks to go higher. This is the total number in the retail investor market. And here's what you need to know about the retail investor. He's not very good, okay? There's a reason the average investor underperforms the market in a big way. They're not very good. They're running on fear and greed. They tend to buy when things are up at highs. They tend to sell when things are down at lows and cheap. And so Honestly, if you want to outperform the market, you want to fade the average investor. And so that's what this allows you to do. It shows us when the put-call ratio gets above 1. That means more traders are buying puts than calls. More people are betting on stocks to go lower than they are higher. And when we get these peak moments of bearishness, when everybody thinks we're going lower, that's almost always the bottom. Because at that point, once all the scared investors have sold, once all the pessimism is cooked in, once things are as bad as they could possibly be, that's usually the low. And so what I've got here is the put-call ratio in blue. I've added a 10-day simple moving average onto this in yellow just to kind of smooth it out. And I've got a couple of lines drawn here at 70 and 8 and 1 and 1.2. And all you're looking for is these big spikes, specifically spikes above the kind of like 0.9 to 1. Okay. And if we go back and look at the last couple of years, look at when these spikes were. This one now might have been a hair early, right in here in October. But these little spikes where the put-call ratios at 0.7, 0.8, then bam, spikes up here to over 1, almost always. Those are great times to buy stocks. And so as these line up, and like April is another one, you got this huge spike. It just soared here April 3rd, 4th, 5th. That was the low of the market. That was the bottom. And so this is going to be a little rarer than that percentage above the 5-day. But keep this in your back pocket. When you see these spikes in the put-call ratio, especially when it gets above 1, that's often the best times to buy stocks. I know it's counterintuitive, but you can go back and test this and you'll see what I mean. So that is how you time the stock market. It's not any one double super secret indicator. It's not one great trick, but it's a combination of these 4 or 5 things that historically we're always going to see in a bull market, that are always going to fall apart leading into a bear market. And if you get in the habit of watching these just once a week, reviewing the numbers, I can guarantee you will start to spot when markets are breaking down, you will get out near the highs, and you will also get back in near the lows following a market sell-off because you know what to look for. When you see net new highs start printing green, when you see the advanced decline line, the percentage of stocks above the 200 rising faster than the market, when you see the NFCI indicator coming up, when you see a giant spike in the put-call ratio, you know to get back in, and you're going to look very smart to your friends who ask, how did you know when to get out? And how the heck did you know it was time to buy? Now, for more content like this, do me a favor, hit the subscribe button down there in the corner. I put out content every day. We share stock tips, strategy, stuff like this, anything I believe will make you money. And I look forward to seeing you in the next video update.